Okay, so welcome to this week. So it's week 2 of MAC 3702. And this week we'll be covering cost of capital, the weighted average cost of capital, or WACC. The format would be as follows. We're going to do a quick high-level overview of the topic, and then we're going to cover a question. When we cover the question, we will go through, we will apply the high-level overview to the question, and we'll cover anything else that we pick up within the scenario. The question we're going to cover is May, June 2019. We'll cover the WACC question. So just so you know, over the course of this 8-10 week course, we will work through 4 question papers. So May, June 2019, October, November 2019, May, June 2020, October, November 2020. So we're going to cover those 4 papers. Then from there, I will have a look which topics we haven't, it doesn't cover completely, and then I'll select from other past papers certain questions. So for example, that is 4 question papers. So at max, if each question have a valuation, then we'll cover 4 valuations. But perhaps it's a 5th valuation I want to cover, then I'll just pull it from another question paper. Similarly, this over the 4 may not have working capital. So then we will pull working capital from another question paper. But largely, we will focus on those 4 question papers. Some of it I will do in class, when I say in class, on Zoom, and some of it is going to be part of your homework, and some of it will be where I record videos and then I upload it on the platform. So that is basically how we're going to structure it. And then at the end of it, you should be able to pass your exam successfully. That's the strategy, the way we have used in the past, and we have been quite successful in that approach. So we're going to continue, and every time we always just improve based on the learnings that we gain. So remember this so part of your learning is going to be threefold. It's this class. It is some pre-recordings that I'll put up. I don't put up a pre-recording every week. I focus on the big topics, and then any homework that or activities that you have to do on your own. Either you submit it or you just do it on your own. But obviously the ones that you submit, I will look through. The ones you do on your own, you can ask me any questions. Like I focus on with the CTA guys, I focus on making sure that you have a way of thinking, that you develop an approach to tackle questions so that no matter what is given to you, you can tackle any question. That's the idea, that's the aim. Because ultimately, when you write this exam, you may not get a similar question to what we cover. The principles remain the same, but how they present it will most certainly be different. Similarly, once you leave the academic world, or if you for those of you going on to CTA and then write the board, when you write the board, you must be able to handle any question because you don't know who's setting the paper. As a UNISA student, you're going to be very used to the way UNISA sets the paper. As a UWC student, you're going to be used to how UWC set the paper and so forth. But when you come to the ITC exam, you don't know who's setting the paper. It's anyone within South Africa, if even in the world. So, so you must be able to handle anything that come your way in that exam as well. But more importantly, so that is our focus, to help you to be able to answer any exam question paper. But we don't just focus on that. Our focus is to go beyond that point, and that is when you step into the real world. So either you go on to become, you go on the CTA route, or you do your degree and you go into the real world as an accountant. You will be asked to do certain tasks. So you have a degree, your finance manager, the FD, whoever it is, will have some form of expectation. So based on my experience as being a financial accountant, being in audit and so forth, I bring that across so that when you enter the real world, you know how what you are learning actually applies to the real world. So that is the extra step that we go. And I believe that that extra step help you as a student to answer exam questions even better. So remember, if I can tell you with this course, together with your effort, you will definitely, this basically is a definite that you will get through. But remember, this course on its own, when I say this course on its own, the course on its standalone, without your effort, is not going to help. When you bring in your effort as well, then you will be successful. So make sure you do your part. Make sure you are consistent in studying. Make sure that you have a dedicated time when you go through your work, um, and create a system whereby you will say every Saturday I'm going to spend 2 to 3 hours working through something, because most of you, if not all of you, are working and so forth, and you most likely don't just have this course, you have other courses as well. So you need to develop a system whereby you have a dedicated time and day to actually do certain work. So make sure you spend that time. And more importantly, like I emphasize with the CTA students as well, it's not about running through 1,000 questions. It's about doing 2, 3 questions thoroughly. That is sufficient. The aim is to do five. When I say five, I mean five per topic. The big topics, when it's smaller topics, you don't have to do five. 2 to 3 is fine. You can't only do one. One is not enough, but at least three, and out, but your aim should be around five. If you can do more than that, great. The chances are you won't be able to, and especially um, the way I suggested you do it, because you must think about it. Most of you are working, have a full-time job. You're not just doing one course, so you need to be realistic. So if you put in the quality, no matter what they throw at you, you will succeed because you are studying properly. And I'll explain to you when I go through this exam question paper, what do I mean by studying properly, so that if you only do 3 to 5 papers, it is sufficient. But you need to do it all the time. And the approach that I give you is a tedious approach. When I say tedious, it's time consuming, but it's really going to wreck your brain, and it's going to teach you how to read different questions, no matter what you are given. So follow the approach. It really, really works. It's not my approach. I developed it when I was a student, or actually when after I was a student, and that's why I want you to develop it while you are a student, so you can actually benefit from it. But many other successful students that I've studied with, if you listen to what they did, I used to pay close attention to the guys that were like the top in the class, how they actually go through things. Unfortunately, I only really mastered it after I left university. So what I'm trying to do is let you develop that now. And 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 basically this approach, because it's so time consuming, won't allow you to go through 10 question papers. But what I can guarantee you, and it's literally a guarantee, that if you follow this approach of what I'll show you how we go through it, and you only do 3 to 5 question papers, compared to someone else that run through 10 question papers, just running and not following an approach that I give you, you will still be far more, you will know far more, and you will do far better than such a person. Because many times when you're just running through a question, you're not even for 1 second thinking. You're just answering a question based on what the question is asking of you, and you're not taking a step back to actually ask yourself the question, what did I learn? What else could they have asked me? How did they present this information? How did this information differ to the previous question? So it's that type of questions that you go through that will, because you're now asking the right questions that will help your brain start to make the necessary connections, as opposed to memorizing. Oh, I saw this one. This was a whack question. Oh yes, in that, if you're trying to remember, then it's going to be a disaster. and especially for Mac 3701, especially for Mac 3702. Why do I say this? You might just pick up the past question papers for Mac 3701, Mac 3702, and compare it to the past papers of FAC 3704, for example. FAC 3704 and probably the other FACs as well, FAC 3701, 3702, 3703, 3704. If you go through the past 10 question papers and you do it properly, or you do it, when I say properly, not in my proper way, but a typical proper way, we're just running through 10 past question papers, you could probably get 100%. Okay, because they just basically, like I say, they just change the numbers and change the company name. Everything else remains the same. But whoever the lecturers are of Mac, they don't recycle papers. They come up with fresh new question papers every single time. And they really prepare students who's going on to CTA for CTA. They really give you really good papers. So especially for Mac, I don't think you would struggle in an exam if you're just running blindly through past question papers. And therefore, especially in this one, like I said, you can do what you want to for the facts, but for Mac, you need to develop a different approach. And it's not about the number of question papers that you can tick off, but it's rather about after every question paper, can you tell yourself in the mirror what exactly you got right, what exactly you learned, what exactly did you get wrong, and why did you get it wrong, and how you need to correct it. If you can do that after every single paper, and if you can tell yourself what was the similarities, if 2019 have a whacked question paper, May, June 2019 have a whack question, May, June, November, October, November 2019 also have a whack question. Can you take the two whack question papers after you have done it and compare and ask yourself, tell yourself in the mirror, what were the similarities and what were the differences? Then you can tell yourself you have learned. But if you can just tell me what the process that you went through in a question, then you didn't really learn, because you're literally just trying to memorize what you wrote in down, as opposed to really thinking what you're actually doing. And that is why comparison is so important, because it really gets you to think. So after, like, probably from week 4 onwards, I'm going to start implementing that, because then we have did enough question papers, we have done enough capital budgeting papers, questions, enough whack questions. Then we start doing that to start questioning similarities, differences, and all of those type of things. Then you will see, you will start to feel that you are learning. When you're done with the question, you will feel that you have learned. So that is the aim. So you must understand what the aim is, and then you just need to do your part. That is, I know if you do your part, you will succeed, because it's a proven method, not mine. I'm just taking from people I've seen it were really successful, what they do, how they learn, how they study, and then I bring it, package it in a manner that you and I can understand, and also bring real world, how we use this in the real world, and how does this relate, how does this learning actually help you in the real world, so you can see that connection and hopefully fall in love with the subject. Remember, that's the idea, that you fall in love with the subject, or if you don't fall in love with it, at least have a fling with it, because even certain flings are good, not good but nice, so I can you know what I mean. um, so you want to get to that point, like, no matter how long I have tutored finance or financial management, I'm always excited by it. I don't know why. I always enjoy it. So hopefully you can hopefully I can transfer that type of enjoyment as well, and you can engage with the subject. So let's move on and give a high level overview of the weighted average cost of capital. I'm going to run through it. I'm just going to give you a quick overview and then a thinking process, a way of approaching a whack question, and then we'll dive straight into the question paper. In the meantime, you can open up the question paper. It is the one I sent in the email, MAC 3701. Okay. So, well, fleeing is a second option, eh? It must be actually you fall in love with it. So, um, with the weighted average cost of capital, the question you'd want to ask yourself is, what is the weighted average cost of, or what's the purpose of WACC? So what you must understand, or let's first say, what is WACC? WACC is basically the general cost of finance to a company. So it's the general cost of finance to a company, general, important. Um, what is the purpose of WACC? The WACC rate is extremely important, particularly for companies like Sasol, Eskom, and so forth that invest in long-term projects that takes long to construct, like take years to construct, and then still take years to actually generate revenue. So the weighted average cost of capital is used to evaluate long-term investment projects. That's number one, in no particular order. Number two, it's used quite extensively in valuations, so that when we come to valuations later down the course. And then number three, it is also used in financial reporting. So as an accountant or as an auditor, when an auditor audits a company, or a financial accountant that prepares the financial statements, they have to most companies would have PPE, property, plant, and equipment, and property, plant, and equipment needs to be tested for impairment if there's a sign of impairment. And part of the impairment test requires you to work out the recoverable amount. The recoverable amount is one of two amounts, the fair value amount or a value in use. Now, the value in use amount requires you to discount future cash flows. And the way you, and the, in order to discount future cash flows, you will need a discount rate. The discount rate that is used is the weighted average cost of capital. So it's also used in financial reporting. There will be slight differences, but the concept remains the same. So there's multiple reasons as an accountant that require you to make use of the weighted average cost of capital. When you want to take a break, but you want to still keep yourself in the mood, Google Google search integrated annual report Cecil. Take any one, 2019, 2020, whichever one comes up. And then you just search weighted average cost of capital. They don't exactly use that term anymore. They use some other word. I cannot remember it. But you will see in so many parts of the report, they constantly talk about that number, because it's such a important percentage for them. One of the CFO's main responsibilities is to ensure that the capital structure is in place so that the WACC rate is as low as possible, because they use the WACC rate to evaluate long-term investment projects. So it gets used in the real world. So that is why that's the importance of the weighted average cost of capital. So it's the general cost of finance of the company. That's the what, and the why, the purpose of it. We went through it. So it is a very, very important number for a finance manager. Not every company is important. So for example, in the financial services company, they hardly have debt. They hardly have any long-term investments. So they don't bother with a WACC rate. That a WACC rate doesn't come across our table. Um, in the one company I was at, we had a goodwill. So goodwill must be tested for impairment. They do a quick calculation. They kind of just sit there and think, oh, what must it be? Cool. And they make up a number, a percentage. Not really, but kind of like that. We don't do an extensive calculation. But other companies like Cecil, that is imagine the responsibility of the CFO is to monitor that number or that percentage. That tells you how important the WACC rate is. So just keep it in mind. What is the WACC rate? It's the general cost of finance to a company, or the average cost of finance to a company. And then number two, why is it important? It is used to evaluate long-term investment projects. It's used extensively in valuations, and it's also used in financial reporting. Okay, so that is the purpose. Now we get into the calculation. How do you actually determine the weighted average cost of capital? The thought process would be as follows. They will tell you, dear student, please calculate WACC. Simple as that. 20 marks, 15 marks, whatever the marks is. Okay. So the first thing you're going to do is write down the formula. Okay, we'll go through the formula when we do the question, but I don't want to mention it now because I need to explain it to you. Then you want to set up your table. So the first thing, write down the formula. Second thing, set up the table. And that is when they say, dear student, please calculate WACC. So we said WACC is the cost of capital, okay, as a general cost of finance. In order to calculate WACC, you need three things. You need to identify the components of capital, or another term, sources of finance. Number two, you need to identify the market rate, that is the cost of equity, the cost of debt. And then number three, you need to determine the weighting. That's the three things you need to calculate WACC. Number one is extremely important. If you can't identify the components of capital, if you can't identify the source of finance, you can't go further. So number one is of extreme importance. Identify your sources of finance or components of capital. The second part, number two and three can be done anyway. I do it this way. So number two is to determine the market rate. Number three, to determine the weighting. So let's talk about the weighting. The weighting is your capital structure. The weighting is your capital structure. What is the capital structure? The capital structure is all your long-term finance. Your long-term finance is made up of long-term interest-bearing debt and all equity. So your weighting is your capital structure. Your capital structure is your long-term sources of finance. Finance is only debt and equity, but this one is long-term sources of finance. So it is long-term debt and equity. All equity is long-term, and only long-term interest-bearing debt forms part of your capital structure. Now, the way you can get your weighting, the way you can determine your weighting is one of two ways. So what you must always know, that you must always use the target capital structure. So you don't use any capital structure, you must use your target capital structure. What is the target capital structure? So basically, the target capital structure is the capital structure, that is the combination of debt and equity, that causes WACC to be at its lowest percentage. Okay, so your target capital structure is the combination of debt and equity that causes WACC to be at its lowest. So that is why every company is going to be different. That is why the CFO of Cecil monitors that closely, because they need to see basically at which point will the WACC be the lowest. Okay, every company have a different target capital structure. For our purposes, there's an assumption that you will have a target capital structure. In the real world, it's unknown. Okay, they don't know if every company actually do have one. But for our purposes, you will have a target capital structure. So now the target capital structure will either be given. If it's given, you use the target capital structure. They will tell you debt is 40, equity is 60%. So you use 40, 60. But in most cases, the target capital structure is not given. That means you need to calculate the target capital structure. In order for you to calculate target capital structure, the assumption is that you use your current capital structure but based on market value. That is why in the WACC calculation, you have a market value column, because you're using the market value to calculate the weighting. What's the weighting? Your target capital structure. So just keep that in mind. You're always using a target capital structure, but in most cases, it is not given. That means we need to calculate it. The way we calculate it is by using the current capital structure based on market value. That's an assumption, and we do it that way. So that is the weighting. We spoke about the market rate, cost of equity, cost of debt, the source of finance. Like we said, the source of finance is the finance that makes up your capital structure. Your capital structure is made up of debt and equity, all long-term interest-bearing debt and all equity. Now, what's important, the source of finance needs to be split into its various components. You can't just have, say, debt and equity. You must say what type of equity. So the typical examples of equity: ordinary share capital, preference share capital. Your typical types of debt: long-term loans, debentures, bonds, and preference shares. So what you should know, preference shares could either be debt or equity. You must look what the question tells you. The question will either tell you that it's debt, or it will tell you that it's equity, or you look on the balance sheet where they classified it. If they put it under equity, then it's equity. If they put it under debt, then it's debt. Another way to understand, and this is only a general rule, it is not a fixed rule, this is a general rule, that redeemable preference shares would be debt, non-redeemable preference shares would be equity. Okay, so that's the general principles and the general rules regarding WACC. Now that we know what we need to calculate WACC, and we know our source of finance, and we know what the weighting is all about, we actually need to work out we need to work out the cost of equity and the cost of debt for each source of finance. And if the target capital structure is not given, we need to work out the target capital structure for each source of finance by calculating the market value for each source of finance. So now we'll break this section into two parts: ordinary capital, ordinary equity, and then the second part, preference shares and debt. Because the way you determine the market rate and the market value for preference shares and debt is exactly the same. So let's start with preference shares and debt. That's the easier part. So with preference shares and debt, we calculate them in the exact same way. The first thing to note is that either the market rate or the market value is given. So when you look at the question, try to pick up which one is given. Okay, it will either tell you here it is, or it will indirectly give you the answer, but one of them will be given. So if the market rate is given, you need to calculate the market value. If the market value is given, you will most likely have to calculate the market rate. So that's the first thing you do for data and preference shares. Identify what is given. Now we will focus on what we need to calculate. So let's assume we must calculate market value. The way to calculate market value, you follow this exact same process to calculate if you have to calculate market rate. I'm just explaining it from a market value point of view. So let's say we have to calculate market value. This is the thought process. You need to identify whether this instrument is redeemable or non-redeemable. An instrument is redeemable if there is a specified date of repayment. So you're going to pay it back in 5 years' time. That's a specified date of repayment. It makes it redeemable. There's a time limit. An instrument is non-redeemable if there is no specified date of repayment. You don't know when you're going to pay back the capital. So that means there's no specified date. So it is non-redeemable. If it is a non-redeemable instrument, you must use the perpetuity formula. Okay, we'll come to it when we do a question. If it is a redeemable instrument, we will use the financial calculator, or we will use a cash flow format to calculate whatever we need to calculate. So that's the thinking process. So let's repeat it. For preference shares and debt, the first thing you do, identify what was given. Once you know what was given, you will most likely have to calculate the other number. To calculate the other number, whether it's market rate or market value, you ask yourself, is the instrument redeemable or non-redeemable? If it is non-redeemable, that is, there's no specified date of repayment, you use the perpetuity formula. If it is a redeemable instrument, that means There is a specified date of repayment. You use your financial calculator, that 5 buttons. If you can't use the 5 buttons, then you must use a cash flow format. Okay, so that is preference shares and debt. Now we go to ordinary equity. Under ordinary equity, you must do the same thing. Calculate market rate, calculate market value. In order to calculate market rate, the first thing you do, you ask yourself, was the number given? In most cases, they're not going to give it to you, so you will have to calculate it. In order to calculate the market rate, there is 3 possible formulas. Either in no particular order. Number 1, the CAPE model, capital asset pricing model. Number 2, the dividend growth model. Number 3, the bond yield plus risk premium. They're not going to tell you which method to use. You're going to have to identify which method is appropriate. The way you're going to identify which method is appropriate is by knowing the formula for each method. So there's a formula for CAPM, there's a formula for dividend growth model, there's a formula for the bond yield plus risk premium. And that will help you to determine which method to use. So let's give an example. The way you think about this is when you look at the market rate to calculate ordinary equity, you must ask yourself, was it given? If not, you have to calculate it. The next step is you must tell yourself that there's 3 methods to calculate the market rate. CAPM, dividend growth model, bond yield plus risk premium. Then the next step is to run the formula of each of them through your head. And then the next step is to run the various variables for each formula. So for example, I'll tell myself, I must calculate market rate. It was not given for ordinary equity. I have 3 options: dividend CAPM, dividend growth model, bond yield plus risk premium. CAPM is calculated as follows: cost of equity equals risk-free rate plus beta multiplied by the market rate minus the risk-free rate. This I'm running through my head or I'm writing it down. So that means there are 3 things that I require in order to calculate the market rate using CAPM. I need the risk-free rate, I need beta, and I need the market rate. So now I know if I see any of those 3 items, then I will most likely have to use the CAPM model. The dividend growth model, the formula goes like this. Cost of equity equals dividends of next year divided by the price today plus the growth rate. Now I know there's 3 things that I need. I need the dividends of next year, I need the price today, and I need a growth rate. If I see any of those 3 things, then I know I most likely have to use the dividend growth model. So that's what you want to do constantly. Always ask yourself those type of things, and that is how you will start getting better. So that's the 3 methods. We will apply it when we do the questions. I'm just running through it now. Then for the market rate, to calculate the market value of ordinary equity, technically there are 7 methods, okay? However, for WACC, we need to know 2. The other 5 we will cover when we get to valuations, okay? So we're going to know 7 methods, but we only use 2 of them for in WACC. Number 1, market capitalization. Number 2, dividend growth model. So, so what you should know, once again, you must run the formula through your mind and then identify what makes up that formula. That will help you to identify which method you must use. So for example, the market capitalization method is market value equals number of shares in issue times share price. So when you see number of shares in issue, and if you see share price, that tells you should use the market value, the market cap method. To calculate the market value for the dividend growth model, the formula goes as this: market value equals dividends of next year divided by the cost of equity minus the growth rate. So if you see cost of equity, if you see growth rate, if you see dividends of next year, that gives you an indication that you should use the dividend growth model. So that's how, sorry. So, so, so that's how you apply, that's how you identify which method to use. So each time, that is why I say it takes time to do a question, because when you are learning, you're going to do this all the time until such a point it becomes so automatic that your brain automatically thinks about it. Maybe now you must force yourself to think that way. So when you time yourself doing a question, you're not going to finish it within time. That is why that's okay. For the first 2 to 3 question papers, don't worry about time. The first 2 to 3 question papers is about developing your technique, developing the thought process, and to actually learn and apply the content. As you master that, now you worry on time. That is just my approach. Some people can apply time from the beginning, great for them, but I would suggest don't worry about time initially. You can fix the time, working under time pressure in the last the last 1 to 2 question papers. But constantly do that. When you look at ordinary share capital, tell yourself for market rate, there's 3 methods. For market value, there are 2 methods. Run the formula through your mind for each method and identify what you would need to apply for each method. That's how you're going to become better, so that when you start reading a scenario, automatically you're going to be able to identify which method is applicable. So follow this and do it. It's going to take time. Like I said, it's not going to be an easy process. But remember, everything great is not easy. Um, so follow the approach, and that is how you're going to become better. So basically, that's the overview of WAC. Now we're going to apply it to the actual scenario, and then you will see how it comes to life. Before we go on, do you have any questions that you want to ask me? Who is 27627? I'm not sure what that is. Can I share your name? Okay. Kayla said nothing. Masina, Prashni, Kelsey, Fahim, 27. Who's 27? Who's 7627? Who's that?
No questions, right?
Okay. Masina.
No question.
Okay, all good. I don't know who is 27627. Okay. So let's go and do the actual question paper. You should be able to see this question paper, May, June 2019, MAC 3702, 100 marks. Yeah, you can see is one question, 100 marks. We're not going to read the entire scenario. I will be here till tomorrow. So I'll tell you which parts we're going to read. I like to read the introduction just to give us an overview. And generally, there'll be some information that will be given to us over there. So let's begin. Let's say Enterprise Limited, ENT, is an established company listed in the food production sector of the Johannesburg Stock Exchange with a market capitalization of 3,216 million rand. So I just want to stop there. There's 2 important information in that sentence. Number 1, they are listed company. That's applicable for MAC, especially in a valuation question. So you must know that they are listed. Number 2, they're giving you the market capitalization. So when you read that, you must now know that market capitalization equals number of shares in issue times share price. So you must just keep that in mind. They're giving you the market capitalization, but you must know how to get that number. That number is made up of number of shares in issue times share price. So you might just keep note. There's a common thing. They'll give the share price right on top. So this is the number you want to highlight. Don't highlight now the entire question paper. Highlight that, because remember, you must think about you're going to be in an exam. You under exam pressure. You are stressed out. You can become hazy in that type of environment. So to make sure you don't forget this later on after reading the whole scenario and answering a 100-mark question, you must just make sure that you highlight that clearly, because you may most likely use this somewhere further down in the question paper. ENT owns 10 production facilities in 4 provinces of South Africa, each with its own abattoir. The company specializes in the production of various processed meat products, which include bologna, ham, vehenes, pork bangers, and bacon. So here, generally the background, this introduction question or introduction part of the question will generally give you a background of the company, the operating environment, and so forth, what they do and all of those type of things. So this, the introduction section of a question is generally more useful for a strategy risk management type question. So important information to pick up. They own 10 production facilities and they are in 4 provinces. So that's important to note. You can and you can see what they specialize in. Okay, processed meat and all of those type of things. This was set at a time when the listerious breakout took place. So so from a risk management point of view, from a pestle point of view, from a Porter's five forces point of view, it's quite big. Okay, so you might just remember that in the introduction part of the scenario. Before they get into specific type of transactions, you will generally get the answers over here for a strategy and risk management type question. So they say, given the multifaceted structure of its operations, ENT has a large number of policies and procedures in place. This results in a very lengthy and complex decision-making process. So let's talk about that, because this will impact a strategy risk management type question. Policies and procedures is a good thing to have. Okay, it keeps a company in order, it provides direction for employees and all of those type of things. So policy and procedures is a good thing. It's not good to have no policies and procedures. However, the policies and procedures needs to support the business. It mustn't hinder the business. So here you can see they're telling you that this results in a very lengthy and complex decision-making process. So although policies and procedures is good, their level of policy and procedures is actually hindering their business. So you need to have that balance where your policies and procedures supports the business, help businesses make quick decisions and all of those type of things, be agile and all of those, support growth quickly. So that is the type of policies and procedures that you want in place. So you should not argue to have no policies. You should argue to have policies and procedures, but that will support the business in moving forward and not hinder their growth. Okay, so that's important to note. So here is a problem that the policies and procedures is hindering decision making of a business. Okay. In 2000, the World Health Organization recognized food safety as an essential public health function and has urged governments to promote food safety in the private sector. In South Africa, there's a number of government departments that are key players involved in food legislation. So now you can, if you think from a strategy, risk management type scenario, they are Enterprise Limited, the environment that they operate in is in South Africa. Okay, so When you apply pestle, you will apply pestle to the South African environment. So here you can see from the L in pestle, legal and regulation. So it seems to be a highly regulated industry, and that there are a number. There's not just one. There are a number of government players involved in legislation, in food legislation. So therefore, this company have to keep track of the various types of legislation within South Africa, um, that is focusing on the food legislation. Then they say the Department of Health is one of the key stakeholders and requires that all food products should be safe for human consumption in terms of the Foodstuffs, Cosmetic and Disinfectant Act, the National Health Act of 2003, and the International Health Regulations Act of 1974. So there are three just within the Department of Health, which is one key player. This company already have to adhere to three different types of legislation. Okay, so just keep that in mind. You can already see that it's a highly regulated industry. Just like the financial services industry, the banking industry, it's highly regulated. ENT adheres strictly to the guidelines and legal requirements set out in the various acts regarding food safety. So there's a positive, they do adhere. Given the 2018 outbreak of Listeria in South Africa, much emphasis is placed on the safety and regulation in the food production sector. Various processed meat products were recalled by the Department of Health, which found traces of Listeria in some of these products. Given the company's strict food guidelines and controls, all ENT meat products tested negative for Listeria, so they had a positive outcome. So remember, when you look at strategy risk management, and when you think about the risk management, we always think about the negative sides. So remember, companies, when they think about the risk management, yes, they identify risks. But when they identify risks, they look for an opportunity. Okay, so they state this is the risk, and then they say what the opportunity for them is or are. Okay. So over here, we know they are a highly regulated industry, um, and we know there was a Listeria outbreak, and many food products were recalled. Okay, so obviously there's people that have that is, and now people can be very careful of buying bologna and all of those type of processed meats. However, this gives ENT an opportunity. What is the opportunity? They can market and let people know that none of their products were recalled because they have such a high standard of what did they say? A high food safety standard for their company, which resulted in them not which resulted in none of their products being recalled. So this they can use this opportunity to boost their product, to boost their sales, and to even just boost their company brand as a whole to become like a leading brand. Okay, so remember, with every risk, there could be a potential opportunity, and here they could actually use that as an opportunity. So don't think when we look at the risks, you must understand that although risk looks at negative things, but you must also look at the positive thing. So if I just give you a typical example from an economic point of view, if you look at a company that maybe imports or export, okay, so one of the key risks would be an exchange rate. But remember, an exchange rate could go up and could go down. So depending on which side of the chain they are, let's say if the exchange rate go up, it's good for them. If the exchange rate go down, it is bad for them. So what you must know, up and down is a risk. Okay, so a risk refers to making a gain or making a loss, but it's just not exactly, you don't have full control over it. So don't think that the risk is only negative. Risks also include a positive outcome. Okay. So this whole section over here will most likely help you answer, I think, part A of this question. So just be aware of that. But for our purposes, What's the important aspect? It's that 3.2 million over there. Okay. So don't forget about that number. So here's where we will come into play. I think this is where we come into play. Additional information relating to ENT. ENT has rolled out a series of print and digital campaigns highlighting the risks and prevention of the listerious outbreak. Okay, so this is part of what they are doing to create awareness. ENT is highly reliant on its personnel due to the nature of their business. Most aspects of the food quality are dependent on the skills and diligence of its personnel. ENT pays careful attention to its recruitment process and ensures that its staff has the required skills and expertise. In addition, ENT strives to maintain positive staff morale by ensuring that employees are well compensated and satisfied with their working conditions. I won't go into detail with this, but this is a way to mitigate risk. Um, I will do this risk question with you sometime, and then I will show you a real world company how they set out their risks, and then you can see how this makes sense to our answer by comparing to how a real world company sets out their stuff in their financial statements. But I'm not going to go through it now because otherwise we're not going to finish. And then they say periodical expenditure is periodical capital expenditure is required to maintain and improve the entity's facilities. Capital expenditure undertaken during the current year includes, amongst other things, the following. Okay, I'm not going to go through all of that. Let me just see if there's anything I wanted to go. I'm not going to go through all of that. I want to read from this paragraph over here, from the next paragraph that you can see on the screen, because that is where it becomes relevant. So they say, for the 2018 financial year, ENT paid an interim dividend of 35 million Rand on 28 June 2018, and a final dividend of 45 million Rand was paid on 20 December 2018. The directors anticipate dividend to grow at an annual rate of 9.06% in the future, despite the listerious outbreak. Now you must already pick up that paragraph is giving you information relating to dividends. Okay, so we know we're going to do a whack question. So here we will most likely, somewhere, we will most likely use the dividend growth model. Either, because remember the dividend growth model for ordinary share capital falls under both market rate as well as market value. You can't use the calculation under both because you need the one for the other. So that means we're either going to use the dividend growth model to calculate the market rate, or we're going to use the dividend growth model to calculate the market value. But we will get into that just now. 7 years ago, ENT issued 105 million preference shares at 3.10 Rand each. These redeemable preference shares yield a fixed dividend of 32.55 cents per share up until redemption. Preference shares in a similar risk class to these are currently trading at a yield of 9% per annum. What's important? You want to identify what was given. So in this case, the market rate was given. When you see currently trading, then that is the market related number. So they are telling you preference shares in a similar risk class to these are currently trading at a yield of 9%. When you see the word similar, when you see the word currently, that refers to the market number. That number that they're giving you is a percentage. So they gave you, or they're giving us, the market rate. So that means we'll have to calculate the market value. When we calculate a preference share market value or market rate, we need to ask ourselves, is it redeemable or non-redeemable? So here's a slightly bit tricky. So they're telling us that it's a redeemable instrument, but they're not telling us when it is going to be redeemed. So that makes it a bit tricky. I'll tell you how to deal with that just now. The next paragraph, they're telling you ENT obtained a 5-year loan from Merchant Bank of SA on 1 November 2014 for an amount of 750 million rand. The loan is repayable at the end of the term, and the interest is charged at prime less 1.25% and is payable annually. As a result of a change in the risk profile of the food production industry, analysts now believe that the reasonable effective cost for such a loan would be 0.25% above the current prime rate of 10.25. So once again, the market rate was given. Why? They're telling you the risk profile of a similar thing is now trading at 0.25 above the prime rate. So you must just be careful, and you must always try to see what is given, and then you will know what you need to calculate. Once again, they give you, it's a redeemable loan, but they're telling you it's a 5-year loan. They told you when you took out the loan. So you took it out on 1 November 2014, and in 5 years' time, you will repay it back. So just take note of that. Then the next bullet point, revenue earned by ENT for the 2018 financial year was 1.25 and cost of sales was 603. The information from revenue onwards, that is basically tackling the financial analysis question. So I'm just going to run through it. Profit before tax and interest expense 397, and then they give you a net profit, and then they're telling you the South African corporate rate remained unchanged. Not going to read through everything. Not going to read through this. We don't need this because this is all for the financial analysis. Potential acquisition, that is most likely a capital budgeting question. I'm not going to bother. And additional information is what I want to talk about. So additional information, when I say, sorry, the potential acquisition, because an acquisition, it's most likely a mergers and acquisition question, a valuation question. So we're not going to bother, not a capital budgeting, sorry. Additional information, they're telling you the earnings yield of a similar company listed on the JSE is 8, and shares, and for the 2018 financial year, shares of a similar company not listed has an estimated trading discount of 4%. That bullet point, it will make sense once we come to valuations. I'm not going to read that. Okay, so all of this is basically for the potential acquisition. So the only information that is relevant for the WAC question is the bullet point, this over here, this bullet point over here. I can't highlight. I don't know why I can't highlight. Okay, but anyway, for the year 2020 financial year, from there up until, so this 3 bullet points, those 3 bullet points is applicable to us. Okay, so just take note of that. So let's go to the required. We're going to do required C. So let's look at the required A. Required A is that SWOT analysis. So I'll do this question with you later on, not today, but later on in the course. And we will use the first paragraph to answer the SWOT analysis. Part B, it's analyze and discuss. It was at other information where I told you relate to financial analysis. So that is part B. Part D, what was part? Part D is also more financial analysis, and I think there was a part E, and then part E is the valuation. So valuation will cover in mergers and acquisitions. Part D is financial ratios, and here we're going to cover part C. So part C is 13 marks. So let's see what they're asking of you. They say calculate the weighted average cost of capital. So that's what they're telling you, what to calculate. So you must already know what you need to calculate. The second thing that's important to note is the date. When you deal with capital budgeting, when you deal with weighted average cost of capital, and when you deal with valuations, it is very important to know what date you must base the calculation at. If they don't give you a date, then you kind of can't do the question because you need a reference point to base your calculation at. So that is why they'll give you the reference point. So they're telling us 31 October 2018. So when you come to a required and they say, dear student, please calculate WACC. The first thing that must go through your mind is the formula. The second thing that must go through your mind is how you're going to set up the table, and you must actually set up the table. The third thing is to identify the sources of finance, and then the fourth thing is to actually complete the calculation. So that is how you want to think about it. When you see, dear student, calculate WACC formula, set up the table, identify and list your sources of finance, and then number 4 is to go about completing the calculation. So you should see Excel. Tell me if you do. You should see Excel. So the first thing when I saw dear student calculate WACC, I write down the formula. So WACC equals cost of equity multiplied by the weighting, value of equity divided by value of debt plus value of equity. I'm going to take you through this formula now. So I'm going to write it down. Plus the cost of debt after tax multiplied by the value of debt divided by the value of debt plus the value of equity. So let's make sense of this so it doesn't look so daunting. So remember, you need 3 things to calculate WACC. You need the sources of finance, you need the market rate, and you need the weighting. So let's start off with the market rate. You need the market rate. This over here, cost of equity represents the market rate for equity. Cost of debt represents the market rate for debt. With cost of debt, we see 1 minus t, meaning it's after tax, whereas for equity, we see nothing. The reason for that is as follows. The cost of debt is interest, and SARS allows a deduction for interest expense. The cost to equity, or the cost for equity, is dividends. Dividends paid is not allowed as a deduction. SARS does not allow dividends paid as a deduction. And that is why, because there's no deduction for dividends paid, we don't take tax into account, whereas there is a tax deduction for interest paid, and that is why we make it after tax. So cost of debt represents the market rate of debt. Cost of equity represents the market rate of equity. So that's the first part. That's one of the 3, identifying the market rate. The second thing is the weighting, okay? Or another one is the weighting. What did I just do? The value of debt plus the value of equity, that represents your capital structure. Remember, your capital structure is your total long-term finance. So value of debt plus value of equity represents your capital structure. So by saying value of equity divided by the total capital structure, you are saying what percentage of the capital structure is funded through equity? What percentage of total finance is funded through equity? So hence, this over here is giving me my weighting of equity. Similarly, on this side, value of debt plus value of equity is my total capital, is my capital structure, which is my total long-term finance. By saying value of debt divided by my total finance, I'm saying what percentage of total finance or total long-term finance is funded through debt? And that is giving my weighting of debt. So this basically over here is my weighting. This over here is my cost, my market rate or my cost. And then we need the third thing, which is my source of finance. My source of finance, here I'm saying this is equity and this is debt. Now remember, the formula is just going as a whole, equity, debt, because we're not going to write down this formula for every source of finance. It's just giving you an overview to tell a person our source of finance is a combination of equity and a combination of debt. But when we set out our formula, we must list the individual sources of finance. So just take note of that. So I just wanted to explain the formula so you actually understand how the formula makes sense. So it doesn't just look as some daunting formula with a lot of letters. I hope that explanation gives you a basic idea of how this formula translates into the actual WACC calculation that we're going to do now. So the first thing when you read, dear student, calculate WACC is to write down the formula. The second thing we said is to set up the table. Your table will look like this, components of capital, or you can say, source of finance, whatever you want to call it, components of capital. Then I will go with market rate. You can do it another way, market rate after tax. Then I would have market value. My market value helps me to determine my weighting, and that ultimately gives me WACC. So there I've set up my table. I did number one, write down my formula. I did number two, I've set up my table. I'm just going to be doing some formatting just for myself. Okay. So when I saw dear student calculate WACC, the first thing I did, write down the formula. The second thing I did, set up my table. Okay, so what you see highlighted over here, those three can be done in any order. I always just go market rate, market value, weighting. Components of capital must be first, okay? Now remember the formula is, we need three things for WACC. So I was going to put this here quickly. WACC is calculated as follows. WACC is calculated as market rate A times B. Market rate times the weighting. So just take a note of that. You don't need to put this in over here. I just have the auditor thing in me, so I always just do this. If you're in audit, you always have to explain what you do, and this is part of the ways we explain. So I'm no longer in audit, but I've developed this habit when I was in audit, so I always just do it, otherwise I feel uncomfortable. So now, number one, write down the formula. Number two, set up the table. Now we're going to do number three, identify the sources of finance. We have identified three sources of finance. The one is ordinary share capital. Every company must have ordinary share capital. The second source of finance, is redeemable preference shares. Redeemable preference shares. And then the last one, can I remember? 5-year loan. Okay, so let me just say So there we have identified our sources of finance. So now that we have identified our source of finance, now we do step 4, which is do the actual calculation. So I'm just going to go through the calculation one by one, through ordinary share capital, then through redeemable preference shares, then through the loan. So now let's start with ordinary share capital. So you can ask yourself, you must tell yourself, I need to get my market rate, I need to get my weighting. The weightings were not given, so therefore I need to calculate weightings by using market value. So basically to calculate WACC, I need to determine my market rate and I need to determine my market value. You can ask yourself, was the market rate given? And based on the scenario, it was not given. They never said the required rate of return for shareholders is X. They never said that. So the fact that they never told us what the required return of shareholders are, that means, or is, that means that we need to, it was not given, so we have to calculate it. You ask yourself, was market value given? And the answer is yes, it was given. Right on top in the question, they told us that the market capitalization for E&T is 3216 million. So that means it has been given. So I can go plug it in. So I'm going to say I'm going to make full numbers. So 3216, they said million. So I'm going to multiply by 1 million. You can decide how you want to do it. You can either keep it in 3216. I just use full numbers because I don't know for the rest of the question whether numbers is going to be in rand millions or whether it is full numbers. And I just get confused if we must use different numbers. So I always work with the full number. And it's probably best that you just work with a full number to avoid any level of confusion. So there should be million, 1, 2, 3, 1, 2, 3. Cool. So I did just follow my thinking. I'm starting off with ordinary share capital. I know I must calculate market rate. I know I must calculate market value. I asked myself, was any of these given? I know that they never, nowhere in the scenario did they say the required return of shareholders is X. So the fact I never saw that anywhere, it means the market rate was not given. The market value, I know I can calculate market value in two ways, market capitalization and dividend growth model. Right on top, in the very first sentence of the scenario, they told me what the market capitalization was or is. And hence, I can just basically take the number and plug it in. That is why when you see those kind of numbers, like the share price market capitalization is generally given at the beginning of the scenario, make sure that you highlight that number so you don't forget. So therefore, I have market capitalization, so I need to calculate market rate. In order to determine market rate, because it was not given, I must calculate it. I tell myself market rate can be calculated in 3 ways. The capping method, the dividend growth model method, and risk yield and bond yield plus risk premium. So the 3 methods to calculate ordinary share capital, methods to calculate market rate of ordinary share capital is basically CAPM, dividend growth, and bond yield plus risk premium. The formula is as follows. This is all in the notes. I'm just as on the notes on the platform. I'm just writing it here. So CAPM, cost of equity, equals the risk-free rate plus beta. I'm going to use B, the letter B, but remember beta is a Roman or whatever type Greek or Roman numeral. So I'm just using B. I don't have that kind of numeral over here. Okay, multiplied by the market rate minus the risk-free rate. So that is the formula. Just pay careful attention that the market rate minus the risk-free rate is known as your risk premium. The market rate minus the risk-free rate is the risk premium. So you must pay careful attention to the question. Are they giving you the market rate or are they giving you the risk premium? So be very careful. Many students make mistake with this. So you must identify what is given, the market rate or the risk premium. Okay, so the risk premium is the market rate minus the risk-free rate. So in order to use the CAPI model, you need three things. You need the risk-free rate, you need beta, and you need the market rate, or you need the risk premium. So just pay careful attention. To use a dividend growth model, it goes as follows. Cost of equity equals D1, which is the dividends of the next period divided by V0. V0 means the price today. So I just want to, for mathematical point of view, so you know that plus growth is separate plus the growth rate. So therefore, to calculate the cost of equity using the dividend growth model, we need the dividends of next year. We need the value, today, and we need the growth rate. So it's very important. This information was kind of given, so we most likely have to use the dividend growth model. The bond yield plus risk premium, cost of equity equals cost of equity, bond yield or yield to maturity, bond yield or yield to maturity, the market rate of a bond currently in the market, plus a risk premium. They'll give you the risk premium. Okay, so that's basically the formula. The word of the formula is the actual formula. So in order to use this method, you will need a market yield or a yield to maturity, and you will need a risk premium. So every single time, like we went over here, market rate not given, therefore calculated. How can I calculate it? Three methods. CAPM, dividend growth model, bond yield plus risk premium. CAPM, risk-free rate plus beta multiplied by market rate minus risk-free rate. Tell yourself, I need three things. What do I need? Identify. It is the risk-free rate, it is beta, it is the market rate, or the risk premium. For the second method, dividend growth model. Dividend growth model, cost of equity equals dividends of next year divided by the current share price plus growth. Once again, I need three things: dividends, growth, current share price. The third method, bond yield plus risk premium. Bond yield is the yield to maturity plus a risk premium. So I need two things: the market rate of a bond and the current market rate of the bond and a risk premium. So that is how you will identify what methods to apply. If you consistently and constantly do this for every single question, and we don't apply this level of thinking only for WAC, we apply it for everything, okay, or for most topics. So you have that level of thinking. So when you read a scenario, you will basically be able to pick up from the get-go what method is applicable. So let's get into it now, and let's get the market rate for ordinary share capital. So workings. So I'm going to do working one. Based on the scenario, I know that I have to use the dividend growth model. Okay. The market rate was not given. There's no information indicate, so therefore I have to calculate it. I know I have three methods. There is no information that is indicating that I should use the the CAPI model. There's lots of dividend information, so that indicates that I have to use the dividend growth model. There's nothing that indicates anything of market yield and stuff relating to shares, so therefore I will use the dividend growth model. So to calculate the market rate, the formula is, I'm just going to go fetch it. I'll just redo it. Cost of equity equals dividend of next year, D1, divided by the current market value, V0. V0 is always current, it is today, plus the growth rate. So that's the formula. So I'm just going to put it separate in Excel, cost of equity, D1, V0, and growth. So now let's go to the scenario and let's go and fetch all of this. Remember, all of this information is not necessarily going to be given. It may be given directly or it may be given indirectly and you need to calculate it. So let's go have a look. If we have a look over here, the 20, if we have a look over here, what did they give us here? For the 2018 financial year, E&T paid an interim dividend of 35 million rand on 28 June 2018 and a final dividend of 45 million rand. So therefore, the total dividends for the year is 35 plus 45 million. But that's the dividends for the 2018 financial year. That is the current dividends. We don't want the current dividends. We want dividends of next year. The way you get the dividends of next year, so D1, dividends of next year is equal to D0, the current dividend, multiplied by 1 plus the growth rate. Okay, so the way we're going to get the dividends of next year is by taking the current dividends, multiply and grow it for the with the growth rate. So just take note of that. Okay, so take note of that. So I'll just do it separately. So we know, actually just do it here. So working 2, you don't have to go through all these workings. I'm just doing it so that you can see the entire picture. So once again, I'm going to have D1 over here. I'm going to have D0. I'm going to have G. Okay, so let's plug in. So they're telling you the 2018 year's dividends is 35 plus 45. Okay, very important. 35 million plus 45 million. 2018 is the current period. We're not looking for dividends of the current period. We're looking for dividends of the next period. But we know that dividends of the next period is the current dividends plus a growth rate. So let's put in the current dividends. So the current dividends is 35 million plus 45 million. Now I'm going to convert it into millions. So I'm going to multiply it by 1 million. So therefore, the full dividends for this year is 80 million rand, 35 plus 45. The growth rate was given to us. They said that management or the board, whoever they said, the directors, anticipate dividend to grow at an annual rate of 9.06% in the future. So the growth rate was given. If the growth rate is not given, we will have to calculate the growth rate. In the notes on the platform, we give you 3 methods to calculate the growth rate. The first method is an annual growth rate. Is a linear growth rate. The second method is a compound growth rate, and then the third is the sustainable growth rate. The sustainable growth rate is the most appropriate method to use, but they don't test it, so don't bother with it. Just know about it, don't bother with it. So we'll either use a linear growth rate or a compound growth rate. You use a linear growth rate if they only give you this year and last year. So you're only dealing with 1 year. But when you're dealing with multiple years, so let's say they give you a number of information that spans over 10 years, that is multiple years. So in order to get the growth rate over the period of the 10 years, we use a compound growth formula. So just take note of that. But in this case, the growth rate is given as 9.06%. Those formulas for the growth rate should be on the platform, or is on the platform. So therefore, the dividends of next year is equal to D naught, the current dividend, multiplied by 1 plus the growth rate. So the dividends of next year is whatever it is, 87 million. So the dividends of next year, they can go see the working. We have it in working 2. It is equal to the 87,248. The value, we already have the market value, which is, it was given at 3.2 million. So I'm going to tell them, given, where was it given? Right on top in the scenario. And then we have the growth rate, which was given 9.06%. I just want to make an important point over here. This formula, D1 divided by V naught. So it is dividends divided by the value of ordinary equity. So you can either have it in total or you can do it per share. If you have it per share, both needs to be per share. If you have it total, both must be total. So in this case, everything is given on a total level. So therefore, I'm working it out on a total level. But if the information was given on a per share level, I'll also work it out on a per share level basis. It won't make a difference to the value. But what's important, both needs to be per share or both needs to be total. But please take note of that. So to get cost of equity, I'm going to apply the formula D1 divided by V naught plus the growth rate. So therefore, the market rate is the cost of equity. The market rate is 11.77. I'm going to tell them where I get this number. And I'm going to tell them if in the event it is wrong, they can go have a look at working 1. Even if it is right in an exam, they still want to go have a look at that number because they want to see your logic and whether you applied it correctly. They want to make sure that you never got it right by chance because they're giving marks for how you went through the calculation. So make sure that you reference. If you don't reference, you run the risk of them not bothering to give you marks because they're not, some examiners, you're not going to go bother to go look for, sift through a question because you must understand their situation. You don't know which number you are, which number paper you are. It could be 3 o'clock in the morning. They've ran through 100 questions already. They either very tired, very miserable, and they don't care any longer. So therefore, if they can't find your information, they're not going to bother looking for it. Okay, so just that's very important. I never used to mark papers, but I used to sit in the tutor room where the tutors used to mark, and then you listen and you see how they think, how they feel, and whether they actually feel like looking through your paper. You will never believe, and this is true on a matric level as well. It was one of my teachers when I was in high school. They were hectically involved in the department, and they actually mentioned this to us. And I've seen it firsthand in the tutor room when tutors were marking. That, and actually, if you read nicely, carefully through maybe Tat Letter 101, some Tat letters of UNISA may even mention of it, that if you make if you present your question in a manner that is easy, the chance of it changing the mood of the examiner is quite high, and making it easy for the examiner to mark. That alone will make the examiner want to look for marks because they so easily follow your question paper. They maybe came from a question paper where it was so difficult to follow, and now they come to yours and it's so nicely set out. I'm not saying it is your writing, your handwriting is like a computer, but it's the set out is just nice, and it's not smudged. The pen you use was a pen that didn't cause a lot of smudge marks. You're not using a Tipex left, right, and center. Please avoid Tipex. Um, so your paper just and the way it's set out, you will never believe the difference it makes when the examiner marks your paper. They will go look for marks because it's so easy to follow. You're making their life easier. So don't take those type of things lightly. To set out your exam paper in a nice manner, think of an Excel spreadsheet. Set out your paper like you are doing it on Excel. That will give you a better idea of how to set out your paper. In a tip, don't start a question with workings. Start the question with the answer. So that's how you can see what I do. I purposefully have my workings below. When I used to write in a paper, I used to start my workings on a separate page. For me, this black line is a separate page. So just do that. You can see over here, I'm marking my workings in red. What I used to do, I used to highlight my workings. So like you have red in an exam, I'm writing with one color, but I would highlight, I only use one highlighter. I didn't have a rainbow. So I would use, I use only two colors, blue and green. So whichever one I had, I would highlight, let's say in green, and then this I would highlight in green. So they can see where they see a green highlight, they know that's where they can find workings. So you might just think about these type of things so that it makes it easier for the examiner. I had a terrible handwriting, I still do. But that is how I try to make it easier for the examiner. Don't underestimate that because you don't know what time They are they are marking your paper, and you don't know how they feel. You don't know what number paper you are. So just think about all of those type of things because it is a human being marking your paper. So you need to factor in emotions. Okay. So that is ordinary share capital done. Now we can go to redeemable preference shares and loan. Now, once again, when we go to redeemable preference shares and loan, we're falling under the category preference shares and debt. In this section, we first identify what was given. So over here, we already read and we identified that they said preference shares in a similar risk class is currently trading at 9%. So that is when you see similar currently, then you know that is the market number and they're giving you a percentage. So it is the market rate. So we go to the solution and we go plug in 9%. So now I'll go to the solution and I plug in 9%. The market rate was given. So the market rate was given. Remember, whether preference shares is debt or equity. SARS sees preference shares as shares, which is equity, and therefore there is no tax deduction. So take note, whether a company classifies preference shares as debt or equity, from a SARS perspective, preference shares is shares, so it will always be equity, and therefore there will be no tax deduction. Okay, there is an exception, there is a separate section in the Tax Act that changes this, but we don't deal with that, so don't bother. So for our purposes, preference shares from a SaaS perspective is always equity. Whether from a company perspective, we classify it as debt. So you don't take tax into account for preference shares. So the next thing we need to do is to calculate the market value. So let's go do the market value. Remember, when it's market value, the general way of thinking is it redeemable or non-redeemable? What makes something redeemable? If there is a specified date of repayment, can you identify a specified date of repayment? If you can, it is redeemable. If you can't, then you can't treat it as redeemable, then you must treat it as non-redeemable. So let's have a look. They call this redeemable, but can we identify a specified date of repayment? So let's have a look. So they said 7 years ago, we issued 105 million preference shares at 3.10 cents. These redeemable preference shares yield that dividend up until redemption. So they're talking about up until redemption, but they're not giving us a date of redemption. So how long do we know? We don't know how long the redemption period is. So therefore, we can only assume that we have to use uh, um, the formula under non-redeemable. We can't identify a specified date of repayment. As a result, we have to assume that it is a non-redeemable preference shares. So because it's non-redeemable, we will use the perpetuity formula. And because if I'm you, I'll be uncertain, so I'll write a note to the examiner. Okay, I mean, not a letter, right? Not a page. You just make an assumption and tell the examiner what you're thinking. So working three, um, I will tell the examiner the question states um, the preference shares, the pref the preference shares are redeemable. However, there is no specified date of repayment. Therefore, I am treating I'm treating the instrument as a non-redeemable instrument. So take note, okay? Unless I missed it, I can't see a specified date of repayment. They're telling me it is redeemable, so I would expect a specified date of repayment. I don't see a specified date of repayment, so I can only treat it like a non-redeemable instrument. So I'm just putting it out there for them so that they know. So we need to calculate market value as you would calculate the market value of a non-redeemable instrument. To calculate the market value of a non-redeemable instrument, we use the perpetuity formula. The perpetuity formula is as follows: market value equals payment divided by I. So payment is in this case dividends. If it was debt, it will be interest. I is the market rate. We have the market rate, so that's fine. So now I can say market value, payment, I'm going to call it still PMT, and I'm going to say I. So I, we already have it. It is, what was it? 9%. Okay, so I is 9%. I is the market rate. PMT, PMT is the regular payment. Okay, the way we calculate PMT, PMT equals nominal value, times times coupon rate. So just take note of that. Payment in this case is dividends because it's preference shares. If it was debt, it is interest. So the general way of calculating a payment is taking the nominal value and multiplying it by the coupon rate. Remember, there's not only one way of calculating it. There are different ways depending on the information given, but the general way, like 95% of the time, you will calculate it by saying nominal value times coupon rate. Nominal value and face value is exactly the same. It's just different words. Just take note, if we had to calculate the market rate, you will just simply rearrange this equation. So just take note, you will use the same method to calculate the market rate for a non-redeemable instrument. You will just have to rearrange the equation and make the market rate the subject of the formula. Once again, the formula is on the platform. So we already have I, now we need the payment. So let's go have a look at the payment. How can we calculate the payment? So they're telling you that we have 105 million preference shares at 3.10 cents each. So to calculate the nominal value, it is 105 million times 3.10 cents. That rand value will give you the nominal value. Then they say these redeemable preference shares yield a fixed dividend of 32 cents. So they're already telling you what is the dividend per share. So in order to get the total dividends, we will just say dividend per share multiplied by multiplied by the number of shares. So take note, we are calculating dividends slightly differently. The normal way you would have calculated the dividend was to take the nominal value times a coupon rate. They never gave us a coupon rate. They gave us the coupon per share or the dividend per share. So we take the 32.5 cents, the 32.55 cents, and we multiply it by the number of shares. Why? Payment is the dividend. Dividend, one of the ways, there's many ways to calculate dividends. One of the ways to calculate dividends is dividend per share times number of shares. So the way we will do it over here is to take number of shares 105 million, 123 multiplied by, I'm going to convert this into rands, 32.55 divided by 100. So the dividends, the total dividends over here is 34 million. So my market value is dividends payment divided by I. So there is that market value. So I can just go and plug it in. So I'll come over here. I'm going to say equal to whatever answer I got. And then I will call it working 3. Next, we're going to do loan. Once again, loan falls under the category of preference shares and debt. So we go look what is given. If we look what is given, we can see again the market rate is given as a result of a change in the risk profile of the food production industry. Analysts now believe that a reasonable effective cost for such a loan would be 0.25 above the current prime rate. So that is the current rate of such a loan. So that is in effect your market rate. So the way we're going to get it is by saying prime rate 10.25% plus 0.25% because the market rate is 0.25 above the prime rate. So our cost of debt is 10.5%. But remember, this is debt, so it needs to be after tax. Applying the after tax rate, we multiply it by 0.72. So my after tax rate is 7.56%. That is given. If you want, you can do a calculation below, but if you're comfortable, you can just plug it in like that. Now we need to calculate the market value. So we have identified what was given. Now we know we need to calculate the market value. Whatever we need to calculate for preference shares or debt, we ask ourselves a question: is it redeemable or non-redeemable? Something is redeemable if there is a specified date of repayment. Something is non-redeemable if there's no specified date of repayment. So we know there is a specified date of repayment because they told us it's a 5-year loan and they told us which date we took the loan out. So we can work out what is a specified date of repayment. So because there is a specified date of repayment, it is a redeemable instrument. A redeemable instrument, we apply the financial calculator. So under working 4, we want to calculate the market rate. The market rate on the financial calculator is the present value. That's the unknown. In order to calculate the present value, the market value, we need the other 4 numbers. So we need the future value, we need PMT, we need N, and we need I. Okay, so let's go back to the scenario. So let's read what the scenario told us, that we took out a 750 million rand loan on 1 November 2014. So we took it out on 1 November 2014. So the repayment date is as follows: 1 November 2014, which is 1 November 2015. But we use a financial year, 1 November 20, 1 November is the same as 31 October. So year 1 would be 31 October 2015, 31 October 2016, 2017, 2018, 2019. So we're going to repay back this loan on 31 October 2019. We are at 31 October 2018. So therefore, there's only 1 year remaining in this. There's only 1 year remaining in this loan. So you must take note of that. So let's plug in what we know. So what is N? N is the remaining. N is the remaining payment periods. Okay, and how you calculate this is basically number of years remaining, number of years remaining multiplied by number of payments per year. So how many years are remaining? There's 1 year remaining. How many payments per year? They told us interest is charged and is payable annually. Annually means 1. So therefore, N is equal to 1 year remaining multiplied by the number of payments per year, which is also 1. So N is 1. My I is the market rate. I is the market rate. We already identified the market rate to be 10.5%. You can either have it before tax or after tax. I'm just going to keep it before tax. Okay, I'll explain this just now. So now we need PMT. The way we calculate PMT equals nominal value times coupon rate. This formula, same formula. Nominal value times coupon rate. So let's have a look. What is the nominal value? The nominal value is the loan amount. So we took out, how much did we take out? 750 million rand. So the nominal value is the capital balance, okay, the capital loan portion. So our nominal value, the capital portion is 750 million rand. So my PMT is equal to 750 million, 123, 123. That is My PMT, I have my nominal value. Now I need to multiply it by my coupon rate. So let's go have a look what the coupon rate is. They said the coupon rate at the end of the lease term, interest is charged at prime less prime minus 1.25%. Your coupon rate is the agreed upon rate. Your coupon rate is the contractual rate. It is the rate that you and the bank agreed upon. It is the rate that the bank charges you. It is the interest rate that the bank charges you. You must distinguish between the coupon rate and the market rate. The market rate is the rate that a similar loan is currently going for. The coupon rate is the rate that the bank is charging you. That is the rate that you and the bank agreed upon when you entered into the loan agreement. So you must be very careful to distinguish between the two. We use the coupon rate to calculate interest, to calculate payment, because that is what the bank is expecting from us. We use the market rate to discount. We use the market rate as a discount rate to bring future payments to its present value. Must take a note of those kind of differences. Okay, so to calculate the payment, it is a coupon, 750 million rand. It is the nominal value, 750 million rand, multiplied by the coupon rate, which is 10.25% prime minus 1.25%. So here, my payment is before tax, my I is before tax. So I keep them, payment and I needs to be the same, either both before tax or both after tax. I generally just keep them before tax. If you wanted it after tax, then it is multiplied by 0.72 multiplied by 0.72. Okay, but I just keep them before. You will get the exact same answer. So if a solution have it after tax, just make sure that you see that and that is after tax. Okay, so don't stress about it. Your future value is the lump sum payment at the end of the lump sum payment made at the end. So it's the lump sum payments made at the end. Okay, and this is equal to nominal value plus or minus a premium. So if it's a premium, you say plus. If it's a discount, you say minus. Okay, so the nominal value is, so the future value is the lump sum payment made at the end of the term, and that is basically nominal value plus premium or nominal value minus discount. In this case, there is no premium, there is no discount, it's simply the nominal value. So I'll just plug in nominal value, 750 million. 1, 2, 3, 1, 2, 3. So let's check it if it is 750 million. Take note, future value and payment must be in the same direction. They must both be positive or they must both be negative. You choose, doesn't matter. Present value and future value will be in the opposite direction. So because I have future value as positive, my present value will come out to be negative. Don't worry about that. That is just how the formula works. But you must know when you go plug the number in your answer, you must put a positive number. So the way I'm going to do this, I'm going to use Excel. You use your financial calculator. I use Excel, the present value formula. They want the rate. So it's 10.5. They want N, which is 1. They want payment, which is that. They want future value, which I have. And then they want type. Type is when does cash flows take place? Does it take place at the beginning of the year or does it take place at the end of the year? You saw that cash flows, the interest payment is made annually at the end of the year. So that means all cash flows takes place at the end. So from Excel, they mark end of payments with a 0. They mark beginning of payments with a 1. So because it's in, I select 0. And there's my number. It's a negative number. I expected it because I had my future value as positive. If I had to have future value and payment as negative, my present value would have been positive. So don't worry about the signs. Just choose one way and stick with it. So there's my answer. I go plug it in. So I'll go over here and I'll say equal to, which is my present value. And it's under working for. I need this to be positive. So I'll just say equal to minus that. And I'll say, you can go look at working for. Now I'm done. I've calculated my market rate. I've calculated my market value. My market value, the purpose of calculating a market value is to determine the weighting. So now I need to do the weighting. I'm done in terms of working out everything for all the sources of finance. So now I'll just simply put the total. So here I'll have total. I'll add up. So this total over here is my total capital structure. So that's 4.3 million is my total capital structure, is my total source of long-term finance. So to do my weighting, I will say equity as a percentage of total finance. I will say redeemable preference shares as a percentage of total finance. I would say loan as a percentage of total finance. This needs to add up to 1. I must add up to 100% because we're just splitting out all the finance, add up to 1. So I'm happy that the calculation, that I split it out correctly. And now I can say A, market rate, times B, my weighting, gives me a number. So there we go. I just need to multiply this by 100. Multiplied by 100. So there we go. So when I add up, my weighted average cost of capital is 10.8%. So yeah, I'll say WACC is 10.81%. As a percentage, although there's not a percent over there, you must know WACC is a percentage. And then that's my answer. So that's the thought process and how you tackle the question. I'm constantly asking myself regular questions as I'm going through the scenario. So it's going to take practice. You may have got it. You may have not yet gotten it. Don't. It's a work in progress. This is just the first question we're covering. As we go through the year, the course, we'll do more than one question. So don't worry. But basically, the idea over here is to identify and is to develop an approach to attempting a question. And the sole purpose should not be to answer whack. The purpose should be, yes, to answer whack, but to also know how to apply the various theories and know the various possible ways I can test it, and then also to develop an approach to thinking. By developing the approach to thinking about the various ways something can be tested, that improves your exam technique. And by improving your exam technique, you will be able to finish a question. Exam technique is also about how you set out your question. So I already have a way of how I set out my question, and this is how I set it out. If I must go right, physically right, as opposed to using Excel. I'll still set it out, like may not be as neat as this, but I'll still set it out in the same manner. So that is what you need to think about. It's not about getting to 10.81. It's about all those other factors that you need to think about. So before I give you an opportunity to ask me questions, once you do this question, what I was speaking about earlier is that now that you have done this question, you are happy. If you have a solution, you compare your answer to the solution. Whatever you got right, you ask yourself, did I get it right by chance or did I get it right because I know I actually knew it? You know whether you got it right by chance or whether you actually knew it. If you got it right because you actually knew it, you are happy. If you got it right by chance, you need to identify what the issues are and then try to fix your problem. Okay. And that's how you're going to move forward. If you got it wrong, the next question you need to ask yourself, okay, why did I get it wrong? Where did I go wrong? So it's all of these important questions that you need to answer for yourself. That when you go through the solution, if you got it wrong, why did I get it wrong? And where did I get it wrong? Why did I get it wrong? You can see, so you identify where you went wrong, and then you can ask yourself, why did you go wrong there? And then you need to fix that issue. So that is the one step, okay, when you mark. So that is basically comparing your answer to their answer. Once you're done with that, the next step, I mean, and you don't have to do this all in one go. The next step is to say, okay, this question tested ordinary share capital using the dividend growth model. But I know there are three methods: CAPM, dividend growth model, risk bond yield plus risk premium. What if it was CAPM? What would I need and how would I calculate it? So now you're already thinking about that. And what if it was bond yield? How would I calculate it? What would I need? So you see, you doing ordinary share capital using dividend growth model, but you are forcing yourself to think about the other methods. Similarly, the market value was actually given. If it was not given, how would I calculate it? Well, there are two methods: growth model, dividend growth model, or market capitalization. What would I need? And that's how you go through. You do the same for preference shares and redeemable and loans. What you'd pick up over here, that we calculated the market value for redeemable preference shares using the perpetuity formula, and we calculated the loan using the financial calculator. So in this question, the market value for debt and preference shares was tested for both. That is redeemable as well as non-redeemable. So in this question, you'll say, okay, they covered both, so you're happy. But you'll say, okay, but for market rates, they gave me both. How would I be able to calculate it if it was not given? What you must know, that you will use the exact same formulas you used over here. It is just that your unknown changes, and the online platform shows you the differences. Okay, so you can go have a look at that. So that is the level. As you can see, what I've asked you to do after you've actually answered this question is to do another level of analysis and level of thinking. And that means it will take up time that you could have used to do another question. But what I'm telling you, that this analysis is far more superior than doing another question. Once you're done with this, you need to either have written down or have a mental check as to what did you learn, what errors did you make, so that when you do question two, before you do question two, you must tell yourself, okay, in the previous WAC question, these were the errors I made, and this is how I needed to correct them. So you do that mental check. So you tell yourself so that your brain is aware that you must not make this mistake in the next question. Then you do the next question. You do the exact same process that we went through by marking yourself. What did you get right? Did you get it right actually, or was it by chance? If it was right actually, happy. If it was right by chance, um, try to see how you can fix it. If you got it wrong, where did you go wrong? Why did you go wrong? Fix it. Then what did they test? Ordinary share capital. They did this way, but they could have done the other ways, and you go through that process. Now you're done. But at this time now, You have done 2 questions. Now you say, okay, in question 1, in question 2, what are the similarities? In question 1, in question 2, what are the differences? And you try to identify those. And when I say differences, it's on 3 levels. Number 1, how did they ask the required? You will see for WAC, they ask the required exact same way. So there's going to be nothing over there. In number 2, how did they present the information? Now, you can't go to the nth degree. You just kind of get a rough idea of how they presented the information. So, for example, in this question, they gave everything in bullet points. In another question, part of it would have been in bullet points, and part of it would be by giving you a set of financial statements, and you needed to identify the components of capital by looking at the balance sheet under the equity and liability section. So basically, you get a rough idea of how they presented information. The next part is then to the next part of comparing is like getting into the detail. So to calculate WACC, we go through this table, but in this question, WACC they tested using ordinary share capital, but I mean for ordinary share capital they used CAPIM, the other one they used dividend growth model. For dividends, they gave me the dividends, but in the other question, dividends I had to calculate. How did I have to calculate dividends? So if you see the level of analysis you are going is on another level. But this level of analysis will set you apart. So you don't have to run through a million questions. You just need to do 3 to 5 and you will be good. Because when you get to question 3, 4, and 5, you're going to be running through it because your brain have already thought of all the possibilities so that when it does arrive, when it do arise, you're already aware of it. So it's gonna be, like I said, it's a tedious process. It seems tedious, but it is a quality superior way of learning. This is what we call deep learning, because you're not just doing surface level is where you're just running through questions to get to the answer. You don't care about the further understanding. And with surface learning, you if something new comes up, if you never saw something before, that is when you go haywire, when you trip. Where in this one over here, you are training your brain to think. You are training your brain to analyze. So when something comes up that you've never seen, your brain has at least some kind of a mechanism to work on. And that is why they'll tell you, when you're stuck with a question, don't run to the solution, because you are training your brain that when you're stuck, go to the solution. But the problem is when you come to the final exam, there's no solution. So what happens when you're stuck? Your brain says, go to the solution. But then it realizes, oh, there's no solution. And that's when the panic comes in. And when you start panicking, you can't think straight. So train your brain that when you're stuck, how are you going to tackle this question? Go back, like for example, Elon Musk would say, go to first principles. That's how he created SpaceX, by going to first principles. So same thing over here, go to first principles by seeing how do you calculate WACC. So if you get stuck, go back to the formula of WACC. So attempt that. I'm going to repeat this over and over and over when we do capital budgeting, when we do financial analysis, when we do mergers and acquisitions. We're going to drill it into you so that you develop that way of thinking. You develop a mechanism so that when you're stuck, you know what to do. And you develop a way of comparing question papers so that you only need to do 3 to 5 question papers, and that when you go write your finals, you're going to feel confident to write that exam, because you already know when you walk into the exam, your brain is already, you shouldn't be doing this when you walk into the exam, you should be relaxing, but knowing how students are, you're going to process various stuff through your mind. So your brain will process all what you have, your way of thinking that you have developed. So just keep that in mind. Like I said, I know it's going to be challenging, but remember, with everything great comes a challenge. So that's from my side. Before we move on, I mean, when I say move on, before we call it a day or a night, do you have any questions for me?
No questions, thank you.
If you don't have questions, then you can leave the lesson. Then I'll end the lesson my side. What's my problem over here? Okay, all good my side. So if you guys don't have questions, you can leave, and I'll end the lesson.
Thank you.
Okay, pleasure. Bye bye.